The thing we've mentioned on numerous occasions is that if you're living off your income is not just your interest; it's also your capital gains,
Sure,
and dividends,
and I think people, even retirees especially, have a hard time switching to that accumulation mode, where for 2 or 3 or 4 decades, they're if they're saving at all, they're putting money maybe in a 401k plan, and so they're constantly accumulating. They pay less attention to it. Becomes a different dynamic for sure. We've talked about it a number of times in the show. When you go into retirement, there still is this mentality of I don't want to touch principal, and I'm not sure that's appropriate. I think I think for people that if they're going to want to have a retirement that they're actually going to enjoy, they have to consider the possibility that some of their principal is going to get used.
And certainly, if you invest in equities, you almost have to, because most of your, or a good percentage of return is in gains, not in dividends.
And there's always times when, I always tell prospective clients, look, we always play it really conservative the first few years, because one of the things that can really rock a 3-decade retirement is really bad years on the front end of retirement. So we try to play it really carefully there. But it's really difficult when you go to this decumulation phase, and let's just say you have $500,000 saved, and you're going to spend, until you get Social Security, you're going to spend $40,000 or $50,000. I mean, I wouldn't spend that much, 20 or 25, a couple thousand a month from your investment portfolio. And then you get a year where not only does it not maybe go up the first year, your overall portfolio, maybe it declines a little bit, and you've spent $20,000 or $25,000. Right. It really becomes unnerving. But we've talked about that certainly a lot in this. Economy still seems to be growing. Now, a lot of people follow this long-term trends, guys. They're trend followers. There's a lot of different formats, but a real common one is a 10-month moving average, and people follow these tools, and that trend has turned bearish. But it strikes me when I look at all the historical data, Fred, when the economy is as strong as it is, and it's clearly, it's not unparalleled, even though Donald Trump likes to think it's the best economy in the world, and certainly compared to what it was, it probably feels that way for sure. And I'm not trying to get political here, though I guess I'm inviting it, but I'm not. But when the economy's growing, even Goldman Sachs came out with anything. I've talked about this chart before. The chances of more than a 10% decline in the broad U.S. stock market is like 4%. So it strikes me that even when the trend is kind of bearish, but when the economy is as strong as it is, usually the bullish case wins out. Though one never knows. One never knows.
Yeah. The other thing is, where there's no particular sign on the horizon of a recession, but when a recession comes, it's quite unlikely to be like 2007 to 2009. A normal recession is discomforting, but it's not scary like we had in the crash of 2008.
There's no question that when we look at the lost decade, so it started off 2000 with a 50% broad market decline in the U.S. Global investors fared much better, but in that one, the broad U.S. market was down 50%. And you normally, at least I normally, when I read history, I think, well, we all get one of those in our investing lifetime. We just got ours. And then 7 or 8 years later, we get a decline that was even greater in magnitude, down some 57%. And I think that recency bias is, in some ways it's a good thing, but in some ways it's not. It's a good thing, I guess, for people to understand that, look, if you can't sit through a 50% decline in your stock market portion of your portfolio, you probably don't belong in equities. But yet, on the other hand, I think it's conditioned us to think that's what all broad market declines look like. And what I'm hearing from you is that was an extraordinary recession, and I called it the Great Recession. It only makes sense that the earnings would go down so much. And of course, capital always outruns itself. But a normal type of recession, it's a slowdown for a period of quarters, but it's not it's a more passive decline.
Right. It's not a financial crisis, which is what we had in the 2008 period. The kind of typical recession is one that's more or less caused indirectly by the Federal Reserve tightening interest rates. The economy slows down a little bit and then gets back to normal. Right now, it's not as pressing because we have such low inflation rates. So the Fed doesn't have to raise rates very, very rapidly.
Yeah, and of course, rising interest rates from the Federal Reserve is a sign that the economy is improving. And so you've talked about that a number of times. It's kind of this paradox that
good news and bad news can both impact the stock market, and sometimes good news can impact it negatively because it suggests that interest rates will be rising in the future because the Fed wants to tighten things.
And speaking of employment, we have almost record low unemployment. We have more jobs than there are people. And that's certainly not indicative of a pre-recessionary type of indication you'd get. You would normally see, the employment situation decline and become not so favorable before you get into recession. We have the opposite of that. Doesn't mean you can't. Does that mean we can't have a recession anytime soon, or just
it's
just probability?
Unlikely, but again, we're not great at predicting recessions.
No, nobody is. But just it seems sensible that it certainly there's not a lot of people calling for a recession anytime soon. Doesn't mean it can't happen.
Well, there's always some people who are predicting it all the time,
full time, every time, and that continues to ride. Again, Fed is indicating that look, they're still going to increase interest rates this year, maybe one more time next year. The market is, when you look at the market and you look at it by the futures rates. So there's this thought that the market also has its probability meter of how many increases we're going to have next year. The Fed's kind of hinting at 3. And the market's saying, well, we think there's maybe a couple of them. But it's certainly not, when we have a 2.25% Fed funds rate, and that's just the bank interlending rate between banks, and that's one the Fed really directly controls. But at 2.25% and a 2.25% inflation rate, it's anything but tight. Would I be correct in that?
I think so.
I think that makes sense. So I think now the stock market and everybody all the pundits are going to turn their eyes to December to see what the Federal Reserve is going to do. Right. But again, it's the sign of why are they doing this? Because things in the economy are improving, and that's a good thing. That's a good thing for companies. They tend to do better. Employment is obviously an indication of that. But about the time we all get excited or get our rose-colored glasses on, is about the time we get. Yeah,
there is one credible, scary story. Two really famous economists, Martin Feldstein and Lawrence Summers, suggest that there may be some problems in the interest rates. Increases may have some impact on stock market prices, which will then impact people's willingness to spend, so that could generate some. And then the kicker is that we don't have the kind of reservoir to pump up the economy, because the interest rates are already low. We're already running a really large deficit. So that's the scary story. But they've been talking about that for 5 or 10 years.
Clearly, look, I guess it always gets back to, we just really don't know what the future holds. If we have a lifetime view, it's probably that the U.S. economy can increase at a 2 to 4% annual real after inflation growth rate. It's usually trend line growth is somewhere in between there, which is, you've talked about this a number of times. We've seemed to have gone from thinking generally that we had 7 or 8 or 9 years of 2% real gross domestic product growth. Okay, we can't even get to 3 or 3.5. Now we're at 3, and now it seems like everybody's saying, well, that's not such a big deal. But a difference between over the next generation or two between a 2 and a 3% rate is pretty significant, isn't it?
Yeah, it's huge. I mean, using the rule of 72, your income would double in 36 years at 2% and 18 years at 3%. So that's a big difference.
And so, is that why, because we've had this not constant, but overall trend line growth rate of somewhere around 3% real GDP, is this why generation to generation we seem to think that each generation is better off than the last one? Right.
It's the idea of well, first of all, we have growth, and then the compounding effect is really substantial. People may think that growth is a normal thing, but until the late 1700s, 1800s, we had very, very little economic growth to go back 1,000 years or 2,000 years. And the standard of living wasn't a whole lot different from then until the 1700s. And it's taken off, where you had this growth of 1 or 2 or 3% a year. And over centuries, it has a fantastic impact.
And even on mortality, right?
Right.
I mean, somehow they're connected.
Everything,
They're
yeah.
intertwined, right?
Right.
It's pretty scary when you go back and look at life expectancy
Yeah.
at 1800 or 1850
Right.
or 1750. You can't hardly imagine it was
Yeah.
so low.
Yeah, that was the same. The arithmetic's the same. We often talk about it's only 1% fees in your investment.
Sure.
But 1% of your investment over a period of time is a huge
It adds
amount.
up.
Yeah.
It certainly adds up, and one needs to be careful there. I'm going to switch a little bit. Again, you're listening to Paul Ruedi's On the Money on WDWS. You can call us 356-9397. See if I can remember the Castle Heating and Cooling text line, 3515357. So if you'd like to text us, that's fine. I occasionally glance over to the screen in time and pick up on that. David you wrote an article. It's a blog. I thought it was really good. The psychology of Social Security claiming strategies. I liked it because it's kind of motivated by the countless conversations we have with prospective clients on this. And there's so many layers of confusion when it comes to Social Security. Tell us a little more about the background of why you wake up one day. And I mean, I know that we like to, and you can go to ruediwealth.com and the guys are, I don't write so many blogs, though I'm trying to change that, but my guys do. And I think this is a good one because one of the building blocks of any retirement, of course, is Social Security. When prospective clients walk in, they treat Social Security, or for some reason, they almost universally seem to treat it like, well, it's not that much. But it's really a ton of money in the backdrop of a plan. When you think whether it's $1,200 a month or $2,500 a month for a couple, or $3,000 a month, when you start thinking about that's an inflation adjusted, income stream, it's really significant, much more significant than I think people think. So it's really important then in the context of a 2 to 3 decade retirement to figure that out. So what is it that brought you to write that?
Well, I think the title really alludes to the fact that this is kind of covering one niche area of Social Security claiming. I really didn't intend it to be a comprehensive article about all the factors involved in claiming Social Security.
No, because that would be literally a book.
It would be, and it's just not what I was getting at. And really, the motivation for this was, we'll do financial plans, and part of every retirement plan that we do for a client is, when are you going to claim Social Security? And most of the time, our plans will show, hey, at least one should delay Social Security, usually not two. Usually, for married couples, a lot of times it's a compromise. One claims earlier and one delays till 70, typically the higher earner. Now, then you show them that financial plan and you explain the rationale, and you get some sort of variation of the response, like, okay, and you can kind of see the wheels turning, right. And you're like, well, I can tell you're not super thrilled or excited about that idea. What's, the issue? And they say, well, I just feel better if I claimed it earlier. And so I typically, if you ask why, there are a few different reasons. That
what's the primary
time again?
What would you say the primary reason is, or the first one that you usually are going to hear in that conversation?
I would say by far the most common is the first one that I listed in this article is, well, I need to get the benefits while I can. In other words, I'm worried that Social Security is going to go bankrupt because I've heard that they don't have enough tax revenues to fund the expenditures. And I want to make sure that I get my benefits while I can before they go away.
And so as long as Fred's here, I'm 62. So let's put it in context. I'm not 22. Mm-hmm. I'm 62. How worried do you think, from a 0 to 10 scale, is that attitude? I better get it before it goes away.
I think it's probably not a great concern for someone near retirement. It's very unlikely they'll change that. The worst in terms of, not necessarily the worst in terms of public policy, but the worst in terms of impact on the individual might be that they would decrease the inflation adjustment, things of that sort, which would be irritating, but small changes. I don't think there's much risk. If you're 30, a lot of things could change between now and then. Social Security could become more means tested, where you would either pay a higher tax rate or offset some other incomes, things of that sort. But for a person at or near retirement, I think it's probably not much of a concern.
Okay, so maybe 0 to 10, a 1 or a 2?
Yeah.
if even that.
Right. And I mean, I guess a concern is one thing, but what do you do about it is another thing. So if that's the case, it's almost a zero.
So what do you do about that then, if that is the concern?
Well, and I think the whole premise of this article kind of addresses that question to a certain degree is, look, I'm not saying the 3 issues we're going to talk about aren't issues. They are issues, but I think they're really blown out of proportion and misunderstood by a lot of clients. Yet they end up making their decisions solely based on their fear of these 3 different kind of concerns. And my recommendation was, look, we can address these issues and we can talk about the fact that they are very real issues, but let's put them in perspective. Let's talk about the benefits of delaying and or potential benefits of delaying, the potential issues with delaying that you're concerned about, the actual likelihood of the things that you're worried about coming to fruition. And then let's make an educated decision about what's best for your life in the context of not just what's best financially, but also, at the end of the day, I think emotions should play a role, and that's kind of how we're going to wrap things up. But, I honestly, at the end of the day, usually Social Security is not a make or break type of decision. And so we do let emotions play into that decision making a little bit, but I don't want it to be the sole factor.
So do you find sometimes, look, if they really, let's suppose a standard issue advice might be the higher earner delays until 70 and the lower earning spouse files for benefits at full retirement age, somewhere around 66, 67, somewhere in that zone these days. If you see that there's real stress going on in there, is it enough of an attitude issue where you go, look, here's what it looks like. It's not that big of a difference. Sometimes we don't get to optimize. If you're going to have a better psychological and a retirement with less worry if you take it both at 66, is that fair game, or do you have to draw the line, or how do you deal with that?
I think so. And really, we're kind of jumping out of order here, but the last paragraph of my article essentially says that. And it says, look, as long as it's not going to really harm you financially to claim earlier, if that's really, at the end of the day, once you have these other concerns more in an appropriate perspective, so first kind of address those things, make sure you're not just fearing things unnecessarily. But if you still just feel after you gain that better understanding of these issues, if you still just feel better claiming it earlier and it doesn't materially cause a financial risk or increase the likelihood of you running out of money substantially, then go ahead and claim early. And a lot of times it is a subtle difference. It's okay, well, the probability of success of your financial plans, 5% lower or whatever, it might be, okay, you can spend $1,000 or $2,000 less per year. It's not
if you
typically a huge magnitude issue.
The psychology could work either way, though. You could say, I haven't claimed, I'm looking forward when I get to 70, if things don't go as well as I expected, I'm going to have this higher income stream kicking in at 70. And the return between 65 and 70 is fairly substantial.
Exactly. And that's kind of what I talked about in the second bullet. But
and the second issue is really kind of the other side of the coin of the first one, which is I need to get benefits kind of while I can. It's I could pass away early. And so in other words, I may miss out on the payments if I make this decision to delay and I wake up on a cloud earlier than the statistics say I'm going to.
Yep. And that was the second one. And before I even get into that, I want to mention one thing, and we've mentioned it before on the show, but for people who haven't heard, when we've discussed it before, actually close to about 2/3 of Social Security benefits that are paid out right now are covered by just their current tax receipts. And I think that gives people peace of mind hearing that, because it's not like, okay, we're running a deficit. Worst case scenario, your benefits go away completely. It's like, no, if they made 0 changes, and basically what they do right now is they fund the shortfall through surpluses that they had earlier that's put into a trust fund and it helps fund it. Well, that's projected to run out. I think it's around 2030, and I need to look at the data again, but it's somewhere around there. So first of all, we have a little bit of a window before it's projected to run out. But even when it does, well, we're still getting about 2/3 of the benefits covered in current tax revenues. And then you talk about, Dr. Gertz talked about some of the adjustments you can make. You can means test Social Security. You can increase the full retirement age. You can decrease the inflation adjustment. there's just a number of things that you can adjust, and probably that they'll retro or probably apply to younger people, not the people who are,
Right.
you know,
And
at
I don't
retirement.
think anyone could imagine Congress saying we're going to cut your Social Security benefits by 1/3 starting next year.
Exactly.
That would be
Right.
political suicide.
And from every time I go and vote,
Yeah.
sometimes I'm the youngest guy in line,
Yeah.
and so it's a pretty big voting pool. Fred, and I don't want to go on too big of a tangent here. Part of this could be solved. I'm not suggesting it should be, with more immigration, more legal immigration potentially. I mean, part of the reason a lot of countries have trouble is they just don't have enough births in their country.
Right.
They're not.
Yeah, we're in between. We're not Japan or Italy or
Right.
Spain, so we're growing, but growing very slowly. But I don't think immigration should be decided on the social insurance question, but certainly having a pool, if you do it wisely, you get people that you don't have to pay to educate.
Sure.
They come in basically at
Skilled.
full speed and start paying the benefits. They won't qualify for another 40 years or so.
And that's
So
what Australia does. I know,
Yeah.
just for some reason,
Yeah.
I know it. There's basically, you're not going to stay there unless you're skilled.
Right.
You're in a
but there's also, it's not like opening the borders to,
Oh, no.
to the caravan or something.
Well, agreed. So, Dave, getting back to that, so I may regret my decision if I wake up on a cloud early.
Yeah. And again, this is a very real potential issue. Yeah. If you say, okay, my plan is to claim Social Security at 70, and then you die when you're 64 years old, well, you never received benefits at all during your lifetime. And that is just not a great scenario, obviously. But the way I think about this is, what's the likelihood of that happening? And I always think of most financial decisions as, there's always a risk to any financial decision you make, and there's uncertainty. And I think ultimately you have to say, what's going to give me the best outcome in the highest number or highest percentage of scenarios? And so I look at this decision as, okay, well, what is the life expectancy of someone who's, call it 62 years old? You could, claim basically that next month, or you could delay till 70. And what's the likelihood of me living past or living long enough to make it worthwhile to delay? Because if you delay, yeah, you're getting, initially it's a little less than 8%, but you get basically an increase in benefits for every year that you delay. And then I happen to know between full retirement age and 70, you get an 8% increase in your benefits every year beyond that. Okay. So there's a very significant benefit to delaying Social Security, but at the same time, well, you just chose not to receive anything for 8 years. So you have to live long enough receiving those higher benefits to basically recoup the foregone benefits for the first 8 years.
So we're really just always, as you said, there's trade-offs, right? You're just trading one. You're always trading one risk off for another. Is that right?
That's exactly right. And I'm looking through my article because I don't have these statistics memorized, but I used a tool called the Longevity Illustrator. It was created by the Society of Actuaries, and it's really pretty sophisticated as far as calculators go for projecting longevity. And what it showed was, for a 62-year-old single non-smoking male in average health, he had a 70% chance of living to age 80. And just for background information, that break-even point for delaying between 62 and 70 is around age 81. So in other words, you have a really high likelihood of living past that break-even point. And the break-even point, as one reader had mentioned, it depends on the discount rate you use, but that's based on basically using the TIPS yield as a discount
Treasury
rate.
inflation protected.
It's around age 81. So to me, that's saying, okay, odds suggest you're probably going to live long enough to benefit.
Okay. We are going to go to John on line 2. John, how can we help you today? You there, John? Line 2?
Here, can you hear me?
Yes, sir.
Yes. Appreciate the good advice over the years.
Thank you.
For many years.
Thank you.
You used to publish a Vanguard retirement portfolio model on your website, and I can't find it, and I'm finally old enough to use it.
You know what?
If it's still there, and I'm not looking in the right place, or what it is.
Okay, so I could probably do it from memory, and maybe that's something we'll fire up again. and actually one of the things we're going to talk about perhaps in this show is kind of the default position can be the Vanguard Total U.S. Stock Market Index or the Vanguard Total World Index, or you could do that at Fidelity in the same way. But basically, it was a blend of the S&P 500, the Vanguard U.S. Large Value, and what I'll do is for the next show, if you'll listen or call me at 356-1400, I should be able to pull that up and give it to you. But it was a blend of S&P, so 70% U.S., it was 80% U.S., 20% international. And again, this is not my advice. It's just saying here's a reasonable model to consider. I always have to do my regulatory work here. Pardon me, John. For you to consider, not to do it. So 80% U.S., 20% international. In the U.S., it was dominated by the S&P 500 index, some U.S. large value index fund, and then they have a REIT fund, which is a real estate investment trust fund, was about 7% of the overall equity portfolio. And then from there, some small value. That was pretty much it in the U.S. I'm not giving you the answer you want, so
No,
go ahead,
I understand.
David.
So one thing that's worth noting is I think nowadays you can actually accomplish the same thing in a much simpler fashion. They have actually a total global stock market index fund, an ETF. Vanguard does.
Right.
The ticker symbol for their ETF is actually, it's V as in Victor and then T. That's their total world stock ETF.
Right.
And that's going to be subtly different than what he described because I think it
But
holds
so close.
everything in its market cap weight. So it has a little more international. But it's going to include a small portion of that's in real estate and REITs, publicly traded REITs. So in that one fund, you basically can cover your equity exposure. And then you could combine that with like their short-term bond fund or even the global, their aggregate bond fund. The main thing that you really can't give a blanket answer on is, how much should be in stocks versus bonds. And that's honestly a lot more important than the sub allocation.
So you feel free to call me, but I think, Dave, you're right. I think, things have changed. Vehicles have gotten less expensive. They've gotten more diversified. And so there's a lot of kind of like, I can take one pill now instead of 5 or 6 pills. And I really think for a global investor that the default fund could be the Vanguard Total World Market Index Fund. And then something like the Vanguard Short-Term Corporate, High-Quality Corporate Bond Fund would be certainly a suitable.
Guys, my phone is not hanging in there,
Okay.
so I'm going to hang up.
Sounds
Thank you
good.
very
Thanks
much.
for calling. All right, John. Sorry about that. But maybe that's something we'll bring back on, and we'll certainly consider it. And if anybody wants to call my office, 356-1400.
Let me go back
I'll
to
entertain it. Go ahead.
Dave's point. If you're hyper risk averse, you could combine a late activation of Social Security along with term life insurance, and you could probably come out ahead.
Sure.
And if the term people don't sell you the insurance, you probably should claim early.
That's true. If you can't get through underwriting, claim early. That's kind of brilliant. I never really thought about that aspect of it, Fred. And so that's a good point.
And one last point on this is if you're married, you need to take into account the joint life expectancy of the two spouses. Reason being, if you delay one person's benefit, not only does it increase their benefit for their lifetime, it's going to increase the survivor benefit for the surviving spouse. So especially when there's a big discrepancy between the two benefits, having the higher earner delay, there's a really high likelihood that one of the two spouses is going to live long enough to make it worthwhile delaying.
Well, go over when we were driving here today, you said you kind of boiled it down to, a few things to make that consideration about delaying or not delaying. Can you go over that?
Yeah. So I think too, sometimes people overcomplicate things and they start worrying about dollars and cents under certain scenarios. And I really liked how one financial author, his name's Michael Kitces, framed it. And he said, look, what is the worst case scenario for someone who's taking a retirement income from an investment portfolio? The worst case scenario is they have poor investment returns over their lifetime. They have high inflation over their lifetime. And what's the last one I was just talking about?
And then longevity.
And then living a long time. Well, what's the best case scenario for someone who delays Social Security? You have poor investment returns, making it a smart decision to delay Social Security. You have high inflation because Social Security is going to increase to offset that inflation, and really long life, extreme longevity, because it lasts for the rest of your lifetime. It's guaranteed for the rest of your life. So he looks at it as like a hedge against that worst case kind of perfect storm for a retiree who's taking withdrawals from a retirement portfolio. And I think that's probably the most important thing. And the way he frames it is, yeah, sure. Say you have a pretty aggressive, we'll just call it a high stock allocation in your investment portfolio, and maybe returns are good for your ages, between 62 and 70, or even over your lifetime. And they're so good to make you technically better off having claimed Social Security early so you could keep that money invested and letting it continue to grow. Well, that's not really that bad of a scenario. Yeah, you might say, okay, well, theoretically you would have been a little better off if you would have claimed early, but that's still a good scenario because you had really good returns. But the flip side is basically the opposite. It's okay, well, let's say you claim early and then returns are really bad, and you live a super long time and inflation's really high. That can devastate you. And so it kind of delaying is a hedge against those really bad things. And then even in the scenarios where maybe you would have been better off not delaying, it's still not so bad.
And kind of finally on this, you kind of alluded to it, that look, we can try to optimize all we want to try, but we're never going to do it because we don't know what the future holds. And so there has to be a realistic aspect of finding that right strategy that's not just purely mathematically right, but part of it's an attitude issue that allows the people to actually enjoy the retirement. And that's really the whole purpose of trying to do all this planning to begin with, is it not?
Exactly. And we can cover the last one real quickly.
Sure.
The last concern that I hear is, well, I need the income. And I think that's just a simple misunderstanding that, if you don't claim Social Security, then you don't get to spend that amount. But when you're building a financial plan, if you have financial assets that you can withdraw from, it's really kind of a non-issue because you know that you're going to have higher benefits down the road and you have that Social Security income stream kicking in. You can withdraw a lot more from your investment portfolio on the front end. So all you do is, if your Social Security was going to be $1,000 a month at 62 or whatever it is, well, you just withdraw $1,000 a month more from your investment portfolio. You end up in the same place, and you smooth that consumption over your lifetime,
or potentially better in some cases.
Yeah, usually better, and that's kind of the point.
It's not a lock. It's not a certainty that you're going to be better off.
And then that raises concerns a lot of times, just because it can be scary. If you're withdrawing 5, 6, 7, maybe 8% from your investment portfolio, things that are not sustainable over your lifetime, but we're talking about a handful of years that you're doing it. It is sustainable, but it's scary because you're going to expect your portfolio to drop. And if you have a portfolio decline and then you withdraw another 8% from your portfolio, that's psychologically taxing for someone
Not
who's
everybody can
a
do
new
it.
retiree. So those are things that you have to consider as well.
Well, I think it's important. Social Security is certainly one of the big components, the retirement plan, even though, a lot of people think it's not. It ends up being, trust me, it's a difference maker. I don't know if it's sometimes, Fred, I think it's too good of a deal, but I don't know why. And I'm not suggesting it is. I'm just saying, being human, sometimes I think, I look at people and wow, well, that seems like a lot of money.
Well, it depends which end of the age distribution you're in. But again, I think it may be a bit like the Roth versus traditional IRA. There are advantages and disadvantages to both, and you can calculate them very finely, but in the end, it does make a huge difference in most cases which way you go. And the same thing is true here. It's important. You can have some advantages by claiming late, but if you make a mistake, it's not, for the most part, catastrophic.
And at the end of the day, we want to have the right attitude in retirement. We don't want to worry. And we want a plan that if it breaks at all, because plans are going to break, things are going to happen. You just don't want a plan to break catastrophically. Yeah. You want to be able to realize, look, things get repaired eventually. So let's not create a strategy or an investment strategy or plan that basically has the potential to break in a catastrophic. I've seen a lot of plans that are built needlessly, almost to assure the investor client that they're going to visit potential catastrophe when they really don't even need to take that level of uncertainty. So that's a real common issue. Why do they stay with this 8%? Is it a legal mandate that they stay, that every year you delay approximately 8% increase?
Well, I imagine
in real
at,
terms.
at some point it was written into the law, and once it gets
It's
there, it's
82 or
difficult.
3.
It's kind of a ratchet. It's very hard to go back in the other direction to lower it now. The one thing that's, I don't know whether it's good or bad for retirees, but it's easier in terms of planning, is you can't, it used to be for some people, they could claim early and then pay back what they got and get it. And that's pretty much gone by. There are a few, for a while, there was a few people who would do that. But I think it's becoming increasingly.
It's becoming, a lot of things have either changed where you can't do it unless you're born before a certain day. I think 1954 is one of them. And then as far as you used to be able to pay it back, now you have to do that within the first 12 months. If you don't do it within the 12 months, then you can never go back. So they certainly begun to change things. And just the fact that they move the full retirement age backwards, it just further increases the penalty for taking it early. And they could certainly, I see a lot of potential solutions to this, whether people like them or not. They could just make full retirement age at 68 or 70, and then you're essentially assessing a penalty that's really worse for taking it at 62 than it would have been when full retirement age was 60.
The other thing which we haven't mentioned here is that for most people, 65 is no longer the retirement age, but for Medicare, it is. So Medicare is a very important aspect of retirement. So you want to, if you retire early, you have to have a bridge between where you are and 65 to deal with your medical costs.
It's become a real planning issue once again, because whether you like Obamacare or not, there were certain provisions of it for some people where it was the difference. Getting that subsidy was the difference in being able to be retired or not, because the private insurance market has gotten so expensive now that if I had to throw out a number that's someone who's 60 or 62 that wants to retire before Medicare, figure assign about $1,000 a month a piece for, is that reasonable?
And that's just for the premiums.
That's just
and
for
then
the premium.
You have potential out-of-pocket expenses of maybe another $6,000.
So you could have a client that maybe had $1 million. They're delaying Social Security. They're living off maybe a taxable brokerage account. On paper, they're poor. From an income standpoint, since it's really all the subsidies are driven by income, they could get a heavy subsidy for healthcare, and so that allowed a lot of people. We may be for or against that. A millionaire is getting a heavy subsidy, but it certainly has changed the dynamics back once again, where early retirement, when I say that, pre-Medicare, has become a pretty significant financial planning issue. It's usually not as big, though. Would you agree? We start throwing around those numbers, $1,000 a month per person, but that might be for 2 years or 3 years. It's going to have some impact, but most of the time it still doesn't keep people from retiring when they want. It says maybe you're just going to spend a little less in retirement, and that's a trade-off.
It does depend how early, though, because
it does.
If you have someone who wants to retire at 55 and they don't have health care through their employer or something, then there's 10 years of that private health insurance. That can be a big difference maker in a financial plan. So it's definitely, it can be something that prevents people from retiring if it's depending on how long that time frame is. But if we're talking 63 versus 65, it's probably not.
So it depends on a lot of things, but it seems like more often than not, the people will choose to retire a little bit early. Fred, with the new Illinois election, just to kind of get on that for a minute, what do we have to look forward to from a financial / economic / taxation standpoint, state of Illinois over the next 3 or 4 years?
Well, I think the answer is probably not a whole lot in terms of having a dramatic turnaround. I think what will happen in the short run is kind of more of the same. They'll continue spending more than the budget allows. There's always this pie in the sky, whether you like it or not. The idea of a progressive income tax is always the lure of it. We can solve our problems that way. But the fact is, it would take a long time. You'd have to, first of all, have a constitutional amendment that could come on the ballot until 2020. And then after that, you'd have to pass a progressive tax. So we're talking about 2 years before that would happen. And I think the question would be, do the Democrats want to bite the bullet? They have the everything going their way in terms of the governorship and super majorities in both houses, so they could approve putting a ballot measure on for graduated tax, and they could approve the tax once if that was approved. But whether they're willing to do that, I think, is another question. A lot of Democrats are not as liberal as you might think when it comes to raising taxes.
And is that even a potential solution? If it wave a magic wand,
Well,
2 years from now, we have a somewhat of a significant progressive taxation in Illinois. Does that begin to solve?
Not really, unless you also raise taxes for people who aren't millionaires. Millionaires are not going to be able to solve the problem. First of all, there aren't enough of them. Secondly, they're mobile, so you can't necessarily do that. So some combination of possibly modestly progressive rates and not necessarily lowering rates for other people might help a little bit, but we still have these major problems in terms of spending and dealing with pensions and things of that sort.
Is there a more sensible tax structure for Illinois than a flat?
Well, again, that's a value judgment that
Okay.
I have. I think that a flat rate is a good idea if you have substantial exemptions and deductions. So what I would do is keep a flat rate, but maybe increase the exemption level to such an extent that maybe people below 20 or 30,000 wouldn't pay very much in taxes, which is almost the case now.
So I have a view that Illinois is going bankrupt. I just don't know whether it's this in 5 years, 10 or 30 or 50. But it just seems like if they just keep doing what they're doing, it's inevitable to me. Is that a wrong way of thinking?
It's not necessarily wrong, but it's not the only option. I think there are ways of kind of creeping along for a long and kind of disabled, but not necessarily bankrupt, which the state can probably manage for quite a long time.
Measured in decades?
Yeah.
Okay. So it's something that I may never see.
No.
At my age.
Yeah.
But it's good. When you look at the state of Illinois, and I know this really is not what this program, and I'm not trying to be political about it. I'm just, for people, we all live in Illinois, and you're well known and understand these issues better than most people. You read about so many municipalities unable right now. I can't remember if it's 30 or 70 municipalities in the state of Illinois that frankly just are cutting services to people.
Right.
How does this end?
Well, that's a more difficult problem with the local governments, because you may have some cities that have lost population and still have big obligations, but the state, I think, is a little bit different. We're still a strong, rich state, and we have a lot of possibility. There's a quote from Hemingway that someone asked, one character asked another, how did you go bankrupt? And he said, slowly and then suddenly. I think Illinois probably is going to be slowly over a long period of time. We have time to make some adjustments. And
as far as municipalities, even though that's not the state of Illinois issue, there's certainly no state of Illinois backdrop. I suppose politics could come into play in some. There's a winners and losers.
Well, it's unlikely that the state's going to assume the debt of local governments when the state has its own problems to deal with.
So the difference between municipalities and states is just, it's almost like in some ways, the difference between states and the federal government. It's just a size, it's about largesse.
Yeah.
I mean, the state of Illinois, probably people are less likely to move out of the state of Illinois than they are to move out of Peoria.
Right. And one medium-sized city loses a lot of industries, they could have a very serious problem, while it's not as likely Illinois is going to lose that major amount of business all at one time.
Right. And we've certainly seen no shortage of that over the last 3 decades.
And if you want, there's not a lot of good news, but if you want good news, the fact is that the interest rates that the state of Illinois is paying compared to more sound places is only 1% or so more.
Why is that? It has to be the market. I guess.
Well, I think
rhetorically,
the market thinks that the state has resources they haven't tapped, and they're much more likely to be able to pay off than you or I may think in terms of impending.
At least over the next 10 years or 15 or 20 years, they may not issue 100-year bonds to them and feel that same way, but for a 10-year bond or a 5-year.
Investors are not sentimental or not charitable, so they're buying with the expectation that the differential of 1% or so takes into account.
So that's true with the federal debt too. I mean, the international players are willing to pay get paid next to nothing to hold our debt.
Right.
They don't have to. They're not. It's not charity. They're just assessing that. Well, it's still the safe haven.
Right.
And
so it's not great that we pay more, but it's not like we're paying twice or three times. It's not like a junk bond that has to pay 15% while other businesses are paying 5 or 6%.
Right. Because that, if it was truly that risk, if the marketplace assessed that kind of risk, that can kind of go from I went slowly to suddenly,
right.
and then you get into that vicious death spiral. Well, I think I feel a little bit better that at least, at least in 2018 or 19, State of Illinois is going to make it through. Well, Fred, I appreciate you being here. I think 2 weeks from now, I think we're going to have Mrs. Pickard, who used to be one of your teachers, on our radio show, because we're going to do some charitable work with the I think it's the Catholic Worker House. I'm sorry, my son Paul's doing it. And so she's going to come in and we're going to talk about that. I know it's not always, that's not going to be a show that's purely financial, but it's going to be about us giving back to the community and kind of highlighting the needs of this, in this particular case, the daily food kitchen that they run. And we're happy to do that. So we're going to have her on. I don't know how much, by the time she tells us all the dirt on the 4 Ruedi kids that went through St. Matthew's, I'm probably going to learn a lot of new things, maybe about Paul. I'll probably
I was going to say,
anyway, thanks for listening to Paul Ruedi's On the Money. We'll be back in a couple of weeks. Thanks for listening.
Join us for the second and fourth Tuesday of each month for Paul Ruedi's On